What's up, everybody? Welcome back to Trades and Gains, as always, powered by Investor Central Club, the coolest and most effective option software in the world. Let's talk about today's market, because, well, if this tape had a soundtrack, it wouldn't be inspirational. It would be kind of like us going to play the Russians in hockey and Miracle on Ice and then getting mopped like 10-0, basically. So, yeah. Or it's like when you wake up in the morning and you see that the majority of the bills you had to pay were in fact denied by your bank because you don't have enough money, and it just kind of ruins the rest of your day. The Dow is currently down, the S&P is currently down but trying to make a comeback, and the Nasdaq is really down. Let's just say that. Silver, it got mugged in an alley and had its virginity taken from it. Bitcoin tripped, fell, and well, it kept falling, kind of like someone who just found black ice. And everyone, well, they're asking the same question here. Why is everything selling off at the same time? I thought some of these were supposed to trade opposite of each other. Well, the answer is simple. Because everyone crowded into the same trades for the same reasons, and now, well, they're all leaving for the same reasons. Simple as that. This isn't panic. This isn't a crash. This is a collective de-risking, and it's way more dangerous because it feels reasonable. So let's go ahead and clear something up right away, okay? This is not retail blowing out positions. This is not margin clerks running wild. This is institutional money quietly saying, yeah, that was cute and that was fun, but, well, we're done. And you can tell because VIX just keeps looking like it wants to explode but won't. There are no circuit breakers, there's no Fed emergency leak, and there's no unexpected event right now. There's just steady selling. That's how pros sell. They don't scream, they don't panic, they just rebalance. And right now, the biggest rebalance happening is this. We don't hate risk, we just hate this version of it. So, what version of risk is getting killed? And I'm very happy you asked. For the last year, AI wasn't an investment theme. It was a belief system. You didn't need profits or margins or even ROI. You just needed a slide deck and the word compute. And it worked until it didn't. Now, we're in the second phase of every hype cycle. The phase where investors stop asking, is this revolutionary? And start asking, okay, but who's actually making money out there? Alphabet, it didn't blow up because earnings were bad. They blew up because management basically said, we're spending a lot more. Trust us. Meaning every time they make money, they're just spending that money on more stuff that will hopefully make money, but is years out still. And unfortunately, that used to be bullish, but now it's a warning label. Because people want results at the end of the day. And it's the same with software. For years, investors assumed software companies would benefit from AI. AI would enhance their SaaS margins. Now the market is realizing AI might replace some of these tools or compress pricing or shift power to other platforms. So software, it's not cheap, it's just uncertain. In Wall Street, it hates uncertainty more than it hates bad news. Now, tech isn't the whole story, because if this was just tech, we'd already be bouncing back. But look around. Everything is cracking. Let's go ahead and talk about the elephant in the room and the data that nobody wants to headline. Job openings just hit the lowest level since 2020. Weekly claims ticked up, and January layoffs were the worst since 2009. And before anyone says, yes, but unemployment is still low, that's like saying the roof hasn't collapsed yet, but like ignore all the leaks, all right? Hiring momentum is gone. It has left the chat. Confidence, it's fading. And companies are cutting ahead of weakness, not after. Now this matters because the Fed watches jobs, consumers feel jobs, and well, markets price future jobs. And right now the message is we're slowing, not crashing, but slowing faster than expected. That's the worst possible zone for markets right now. So where did people hide exactly? Well, they ran to the usual places, and unfortunately, those places failed them. Silver, it didn't correct. Silver collapsed. Down double digits, erased days of gains in hours, because once again, we learned something isn't a hedge if everyone owns it for the same reason. Silver, gold, and even some commodities became crowded risk trades wearing a safety costume. When liquidity tightens, hedgers go ahead and sell, specs sell even faster, and that exit window gets as tight as your rusty balloon knot, let's call it. This wasn't macro doom. This is what we like to call positioning math. Gold is holding better, but the message is clear. Safe havens don't work when they're funded with leverage. And then we have crypto. You know, digital gold, as some people might call it. Bitcoin broke below 70K, and it did it without drama. No hacks, no bans, no scandals, just one sentence from Treasury: we're not bailing out crypto. And suddenly, the entire bull case had to stand on its own legs. By the way, Keone will be taking 255 puts on for 2.6 at $1.03 average for anyone interested. Now, the Bitcoin thing is awkward because a lot of holders bought near 90K via ETFs, and now they're completely underwater. Underwater is saying it nicely. They're currently drowning in a puddle, and now they're patients, not buyers. Crypto doesn't crash because of bad news. It crashes when belief runs out of liquidity. And right now, positioning is heavy, sentiment is just completely broken, and there's no catalyst in sight. That doesn't mean it's dead necessarily. It means the market is saying, we'll go ahead and revisit this at a later date. So this is the start of something worse, right? Well, here's where nuance matters. Let me be very, 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 very clear about something, okay? This is not a 2008 moment. This is not a systematic crisis. This is a valuation and narrative reset. Markets are repricing AI timelines, earnings durability, consumer strength, and labor assumptions. That's uncomfortable, but guess what? It's healthy because rallies built on hope, cheap money, and vibes always end the same way. What comes next is depending on one thing. Can earnings justify these stories we've been told? If yes, we stabilize. If not, well, the grind is going to continue. So here's the takeaway, and this is important. Don't confuse volatility with collapse. Don't confuse selling with panic. And don't confuse AI with automatic profits. This is a market that is transitioning from buy everything with a story to show me cash flow, margins, and discipline. Because every time I talked about earnings, what was the key theme? Margins. Exactly. Now, that doesn't kill bull markets. It just makes them more mature, okay? And the people who survived this tape aren't the loudest. They're the ones who waited, watched, and they, most importantly, didn't chase. Because in markets, just like politics, the truth usually arrives after the applause stops. Anyways, this has been Max Pitts with Trades and Gains. We're hanging out right now over on free Wi-Fi radio and watching some price action, so feel free to go join us over there. Make sure you like, comment, subscribe. It helps take the channel out a long way. And use that code SUPERMAX20 at investorcentralclub.com for 20% off your first month. I hope you guys are having a great Thursday, and I will see you guys in the next video.